Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, December 6, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And it was a pretty mundane day out here compared to the last couple of days. The market took a pause. The SPY was basically flat on the day. The S&P cash index was down less than 1 point. So all in all, the markets were relatively quiet. We had a little bit of a dip, a little bit of a rally, but for the most part, we opened where we closed, and therefore, nothing really changed with the forecast, and there's no new information that we can derive out of the activity today. So the forecast remains the same. My expectation during this week is for a retest of last week's lows. Whether that happens over the next day or two remains a mystery, but that's what I believe is the case. And what would take that off the table? The first sign that that may not happen is if we begin closing hourly and then certainly daily above yesterday's high. That would put the forecast of a retest of last week's lows into question. Barring that, I still think that's a distinct possibility, and that's the forecast that I go forward with. I don't really have anything more to talk about on the daily chart since nothing really changed. And just to give you a bird's eye view and put in perspective, this is today's activity. We didn't do anything today. The market went up, it went down. It basically traded in a very narrow range all day long, and therefore no new activity, no new information, no new evidence in the SPDRs whatsoever. On the hourly chart, we have a little bit of evidence to talk about, which is a bearish pattern that basically developed all day long. So no new evidence on the daily chart, but when we look at the hourly chart, you can see here that we are in a bearish formation. So we've had the down move, and now we've basically been hugging underneath the 50-period moving average in a bearish formation, and this will generally promote another move downward. And this is why we look at multiple time frames. When you look at the daily chart, you don't see anything. You see a narrow ranging day, no new information to speak of. When you look at the 10-minute chart, we basically just went back and forth all day long in that same narrow range. But when we look at the hourly chart, we can see that we are in a bearish formation, and until and unless we begin closing hourly above the 50-period moving average first, and then if we got to the 20 and began closing above the 20, that would call more downside into question. But all in all, right now, this is a bearish pattern, and it normally will play out to the downside. While we're on the hourly chart, we might as well take a look at IWM. And in the IWM, or the Russell 2000 Index, my favorite leading market indicator, we see the exact same pattern. Below the 100-period moving average, below the 20, and below the 50, it's weak. We're hovering above the 200. And on the hourly chart, it's the same bearish pattern. This generally will spell more downside coming in the IWM. Now, the IWM, I'll go over to the daily chart. There's a couple of interesting things out here. It was certainly the weaker index today, down about 0.5%, while the other indexes were flat. You had the Dow was flat, the NASDAQ composite up slightly, but really along the flat line, and the S&P was flat. But the IWM was not flat. So that's interesting. The transports were flat. We'll get to those in a minute. But the IWM, my favorite leading indicator, was definitely down on the day. We'll find out if that's a leading indication of what's to follow over the next day or two. The other interesting thing that I thought today was particularly of note is the fact that we came down today and basically touched the top of the upsloping trend line that comes over from the monthly chart. Now, let's just give a refresher of what this looks like. Here's a long-term upsloping trend line that the market has respected on a number of occasions in a number of different fashions. So when we connect these pivot lows here, here, and here, it gives us the upsloping trend line. And we couldn't get above it here, and we failed. When we finally came back to that trend line, we hugged it for many, many months until we closed above it in the month of September. We closed above it in the month of October, and we closed very comfortably above it in the month of November. And here we are coming back to test the top end of that trend channel, or that trend line, pardon me. Now, we know what was once support, or what was once resistance, becomes support, and what was once support becomes resistance. Right now, the trend line is acting as support. The question is, are we going to break down below this trend line intra-month? It doesn't really matter that much. What matters is where we close the month. Do we close above or below the trend line? We'll take a look at this at the end of December, but that will be the important close. The end of December, where do we close as it relates to this trend line on the monthly chart? As long as we stay above this trend line, the IWM is in the most bullish position it can be in, telling us that higher prices are coming. Can we dip below it intra-month and then come back to close above it by the end of the month? Of course we can. I've got my eye on the IWM right now on the short term, telling us more downside is coming in the IWM. The transports, much like the spiders today and the Dow, nothing happened in the transports. We don't have any new information. We basically put in a doji candle. That means we closed where we opened today, and still yet, as it relates to the transports, a pretty narrow range all day long. So no new information, no new evidence. After making a significant new high on on Monday, we had a sizable decline off that high, a pretty decent down day yesterday, and today the market treaded water. The transports just treaded water all day long for the most part. No new evidence, no new information. The transports are extremely overbought on a short-term basis, and what we've been discussing is that the transports will either have to come back toward home base, the 20-period moving average, the red trend line is home base, so the transports will either have to come down to home base or they'll have to go sideways, allowing home base to come up into price, or some combination of both. Therefore, we're going to move on because nothing happened in the transports today of a material fashion. Switching over to the gold market, gold was basically also treading water in a very narrow range, and this goes for basically almost all the markets. The markets were relatively quiet, narrow range, not a lot of new information in gold. We obviously broke down below the 200-period moving average, closed near the lows yesterday, and today it was somewhat of a paltry effort at a dead cat bounce, and so we may put in a sideways bearish wedge pattern out of yesterday's move, so we could have another few days of a move like this. And as long as we stay underneath the 200-period moving average, this is potentially setting up for another move downward if we put in a bearish pattern. It's too early to tell. We need more evidence. We need some more activity in the gold market, but the trend right now in gold is certainly down. I'm going to be looking toward 1229 spot 30, 1228, 1230, in this neighborhood, give or take a few points. That's where I'm going to be looking for if gold should drop significantly. That's where I'm going to be looking for a sign of a trend change, market reversal. That's an area that I would be interested to get long the gold market. Before that, I would have to see a significant reversal take place before considering a long position in gold. I'm not short. I'm just going to let it play out. I'm going to watch it, let it fall if it's going to fall, or let it put in a pattern that tells me I have a high probability of knowing what the next move is likely to be. Until and unless one of those things happen, we just watch it. We're just spectators. In silver, there's your $16 an ounce in silver. We're actually slightly below that now by 3 pennies, and it's weak, and it's most likely going to fall further. If we see the dip in gold I just talked about, the likely scenario is silver's down in the $15.50 range, give or take a little bit. Same story, not interested in being short, certainly not interested in being long. If it falls, be looking for a sign of a trend change or market reversal. Same story we just discussed in gold takes place in silver as well. Crude oil got taken out behind the woodshed today, down almost 3%. So that's a significant drop in the price of crude. I want to show you an intraday chart a second. Remember, I said the 5640 could be an area of support, but you can see where we cut through that area like a hot knife through butter. Let me show you the intraday chart, show you the 10-minute chart, and take a look at what happened. So we had a big, large down candle, and you can see right here, this is one of the reasons why we didn't stop at 5640, because we dropped, we consolidated above it, and this is building energy for another, push lower. Had we come into this level from all the way up in this zone, that may be a different story. But the fact that we dropped, consolidated, that diminishes the importance of the 5640 that I thought it would have. But look at anyway. So we dropped below it. We tried to rally back to that level, and we failed. And we tried to rally back to that level again and failed right at that level. And then we took a final drop, and now we're putting in another bearish pattern in crude oil. So when we go back to the daily chart, you can see here that I've got my eye on the next level, which is all the way down at $55 a barrel. And also you have the 50-period moving average about 60 cents below that. So anywhere between 55 and 54.5, 54.40 is an area that should be supportive of crude oil. But it certainly got taken out behind the woodshed today, and we closed below the 20-period moving average, which temporarily takes off the most bullish pattern that we could have had and the most bullish uptrend that we could have had. So the bigger picture is the uptrend is still not really broken. We're still just overbought on a short-term basis. And I think all that's happening now is crude is working off some of the overbought condition and correcting itself a little bit. And here's another reason why we shouldn't be surprised to see where crude is going to find support if it should come down farther. So let's draw a trend line in from these pivot lows, and we'll connect the pivot lows. And what you'll see here is that this comes in, it's not exact, but it's close enough. As you can see, if we came down into the $55 area and the 50-period moving average is sloping upward right below this trend line I just drew, you can see why there's a lot of support in this general area, and tomorrow we'll be over here, and you can see where we converge between the upsloping trend line I just put in and where the $55 trend line comes across. So this is generally going to be an area, I think, of pretty good support for crude if we have another significant down day tomorrow. You also have, of course, these pivot lows right down in here. That's another reason why the market should find support in and around that $55 area. We could intraday certainly pierce through that a little bit, but if you're a trader, I wouldn't be afraid to start dipping my toe in the water for a trade, an intraday trade below $55. We should see a snapback above that level if we dip below it. That level should be supportive of crude oil. In the bond market, we continue to edge our way higher. Tried for another breakout today. We made a higher high than we did on the 1st of December, but we fell back down, was rejected a little bit. However, this is in an uptrend. We're above all the moving averages. It's working its way higher. Essentially, the bond market is doing exactly what I said the last several days, which is trying to get through this area here. You see we're right above there right now, but the official close hasn't taken place yet. But this is what's taking place. The bond market seems to want to edge higher, and if we can close comfortably above this level, then I contend we're going to take another run around this double top area, 157, 158, in this zone. At that point in time, I would be looking very closely for signs of a reversal or a trend change, because I think the longer term picture is for significant downside in the bond market, but I think we're going to take another test for these levels before that takes place. It could take into early next year to get all the way up there. It could take into January, February to get up there. That's okay. You have to be patient with it. It's not going to happen all at once, but you can see here, this still remains in an uptrend. It's fighting the moving averages. We got back above the moving averages after being below. That tells me it's bullish. That tells me the bond market wants to take another run at that double top area. Nothing's changed. The forecast still holds true. The dollar was up slightly today. We came into the convergence of the 50 and the 20 period moving average. We're comfortably above the 100, But there's still a lot of overhead resistance here. In order for the dollar to stage any kind of a meaningful rally, the first order of business is we have to get above, I didn't mean to use that tool, I meant to use this tool. We have to get above this red candle high. Until and unless we get above that red candle high, then there's nothing doing. Then this is still just nothing other than a bearish wedge pattern. And that's not changed. We came into the moving averages. This will generally promote another move to the downside. No change in the picture of the dollar. And with that, it's everything I wanted to and intended to discuss tonight. So I will give it a wrap there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.